Please welcome back to the stage your host, Ben Lapidus.
All right, my best ever fam. How are we feeling after that lunch? We doing okay here? We feeding you right? We taking care of you? Being hospitable? Yeah? All right, I'm going to take the silent clap. I'll take that. Feeling a little bit settled in, ready to learn about all the different ways to raise capital. If you are out in the halls, we got these doors open on purpose. I want you to hear my voice so that you know it's time to get rocking again. I'm just going to do a quick head count. I'd say like 45, Hunter. 45. All right, so here's our afternoon. We're now talking capital markets. We're talking about fund of funds. We're talking about institutional capital. We're talking about family offices and equity. We got a guy here that was more or less an architect at Fannie Freddie during the GFC. So we're going to talk about the historical outcomes of those lessons learned from that vantage point. We got a pretty interesting, somewhat technical afternoon. So don't let the lunch fool you. If you need to get up, stretch around a little bit, have some coffee, let's stay engaged. It's just some dry technical conversations, not the next one, but this afternoon. We got some dry technical conversations that we're going to make as fun as possible, but this is the important stuff. This is how we make margin, is through capital markets. So with that, first, to get us kicked off, after lunch, we need an energetic person, right? It's been lunchtime. We need an energetic person, so everybody knows the Instagram man, Hunter Thompson. Hunter Thompson, there he is, brother. Good to see you.
Thank you. Thank you. I appreciate it. Woohoo! Okay. All right. So, how many here are sponsors that are interested in raising capital? Raise your hand. Okay, cool. How many here are LPs that are interested in maybe making some money from their side hustle and flying out and doing all these cool things? LPs, raise your hand. Okay, only like 8 people raise their hand total. So what else is there? So if you're an operator, raise your hand. Come on. I know it's after lunch. All right, cool. If you're an LP, raise your hand. Okay, there we go. And then if you're a service provider, raise your hand. Okay, cool. So good little mix here. So let's try this. If you know me or I'm popping up on your news feed at all, make some noise. Okay. If you don't know me and I've never popped up in your news feed, make some noise. Wow. Okay, good to know. So I don't do events where everyone's seated and not engaging. So the first thing we're going to do before we get started, especially for those that don't know, we're going to do an activation and we're all going to stand up 100%. So I need everybody, I don't care, operator, sponsor, LP, never done this before, stand up please, and we're going to do some air squats. Are you with me? In the front, you got to stand up. This is going to be a war of attrition and the war will not end. All right, air squats. This is what an air squat looks like, okay? We're going to go to here. We're going to stand up. That's 1, all right? We're going to do 10 air squats to get this party started, but it's not just going to be me and my voice. Are you guys with me or what? Yeah. Okay, now we're good. All right, now I've built some brand equity. But we're going to do this with music. So DJ in the back, I asked you to play a specific song. I don't remember the name, but again, it goes like this. Can you play that one? Do I need to sing it again? That's the one! All right, you guys with me? We're gonna do 10. When I say are with me, you say yes. Are you with me? All right, here we go. Let's do it. 1, 2, 3, 4, 5, 6. Come on. 7, 8, 9. 10. All right, you guys can sit down now. Feels good to move around. All right, let's get it popping. So how to make it easy to get $500,000 checks from fund managers. If you guys are interested in doing this, I figured out a way to do this without have other people own your souls by selling your soul to institutions, basically. I definitely didn't invent fund of funds or anything like that. I think this sounds self-aggrandizing, but it's just kind of luck. The first deal I did was a fund of funds. I didn't learn it from anyone. I thought that I thought of it, basically. But because the first deal I did was in like 2012 or so, and the structure is very powerful, I think I played a bit of a role in the popularization of the fund-to-funds model, at least a little bit of a role there. And so today I'm going to break down kind of what it is. So what we're going to do is we're going to talk about the exact framework we use to raise capital through fund managers, how to create a done-for-you fund management system in your business, especially if you're a sponsor, and how we help get capital raisers, especially on their first raise, regardless of their track record. And we just did this at a place, North Edge, Phoenix, Arizona. I'm a multifamily operator. The main way we raise capital is through fund managers. And the last deal we did, 90% of the money we placed was through fund managers using this exact thing. Now, I'm going to keep this very brief. There's some attorneys that are here, and you should go and talk to them. I know all the attorneys that are outside. I have a lot of respect for every single one. They know much more about this topic than me, but I will say the things to ask them are kind of unique, and I'm going to keep this very, very brief. And I don't think that what I'm going to say is much up for debate in the sense of this is all a conversation you should have with your attorney, certainly not me, but I'll try to keep it as middle of the road as I can based on the conversations I've had with attorneys. This is not legal advice, though, and this is a very nuanced topic. Do you guys understand that? Yes? Okay, because by the way, the lights are very bright. So if I say, do you understand? You say, yes, then I know, okay, it's working and people are still there. Okay, so when you get into the world of pooling investors together, which is what we're going to talk about, to invest in someone else's deal, you're no longer buying interest in real estate, you're buying interest in a security. And there's a difference in terms of the legal structures. A lot of you are probably familiar with this branch of law that's like 506D, and 506B, 506C, and it's under Reg D. There's a different branch of law which is about investment advisor rules and investment company rules, and that's associated with buying interest in securities. So there are different branches of law. And so sometimes you need to make sure that your attorney is not just a specialist in Reg D, 506B, 506C, but also understands and is a specialist in Investment Company Act and the Investment Advisors Act, which most of you are probably not focused on because you're not already doing a ton of this. I know it's a little bit technical, but does that make sense so far? Say yes. So just please, it is nothing to joke around with. Talk to the attorneys that are outside. Like I said, they all have different perspectives on this topic and the nuances, but all of them I think would agree with that so far. So now, the other thing that they will all agree with, I hope, is that this can be done correctly. It can also be done incorrectly. So just talk to an attorney that is specializing in Investment Company Act and investment advisor rules. Now, how typical syndications work is you have an operator here and you have an investment property here, and essentially you pull a bunch of passive investors together to go and buy a property that looks like this. Now, in the world of real estate, these companies tend to have similar structures where you'll have an operating partner and a capital partner. One person is focused on operations, the other person is focused on making it rain. Okay, so my title is not Rainmaker, but I like to say that I am the Rainmaker, and Tyler is the operations person, and we kind of divide and conquer in a big way. But what people find when they create these management companies, that's what these companies typically look like, right? Capital partner, operating partner, they come together and they do this. Now, most people find that the limiting factor in a lot of these businesses is how much money they can raise. And so earlier in the last 10 years, what people would do is they would take the same structure and just take it to the nth degree. They'd be like, okay, I've got an operating partner, but then I have one capital partner, he's gonna raise $500,000, I have another capital partner that's gonna raise $1 million, and then this guy's gonna raise $2 million, and this guy's gonna raise $300,000, and together we can go and buy a big, awesome property. The problem, though, is that when you go and look at the operating agreements of a lot of these companies, the ownership percentage is based on how much these people raise. And the SEC thinks that's not allowable because it's basically a violation of broker-dealer laws. You're not allowed to give money or shares based on investment commissions, basically, unless they're licensed under a broker-dealer. Now, I know a little bit about this because I used to be a registered representative under a broker-dealer and learned the rules. And it's way more strict than most people think. So the SEC sent out guidance, as a nice way of putting it, saying, cut the shit out. Don't do this thing where you have 50 co-GPs and everyone's raising different amounts of money. Okay? So while this was happening, and kind of before that actually happened, I just thought this would be a cool way to partner with some really good operators, myself personally. And so what I did was, I was like, I'm going to be this fund manager here. I've got an operator that's here, and they're really good at buying investment properties. And so what I want to do is, I want to find like 10 investors, pull them together, and then I could have like maybe $500,000 or so in this fund of funds. And I'll go to this operator, and rather than try to convince them that I should be a partner with them, rather than try to convince them they should cut me in on their acquisition fee that they work so hard on, I'm just going to say, if I show up with $500,000, would you give my SPV a better deal than a typical $50,000 investor? Because I'm just going to be investing like 10 times what a normal investor would be. Would you be open to that? And they would. Okay? Now, maybe you might be seeing this, being like, hey, there's a middleman here. Like, they're investing through this middleman, and you're absolutely correct. So, like, why would anyone do this? And the answer, there's a lot of answers, but the one that you're probably most focused on is like the economics. How would this make sense economically? And what I found is that, like, in today's market climate, this is what these deals typically look like. Now that this is becoming more evolved, you have a typical class of shares for normal LP investors that are like, a $50,000 minimum, where you'll have a 7% preferred return followed by a 70-30 split. And if someone brings $500,000 to the table, they maybe get access to this preferential class of shares, which is a higher preferred return and a higher split. It's like an 8% pref and a 70-30 split. Is this making sense so far? Yes? All right, I'll ask one more time. Is this making sense so far? Yeah. Okay, cool. If you see me afterwards and it doesn't make sense, just let me know. I'm going to keep moving as if it's all Gucci. So, the interesting thing about this, though, is that the delta between these two allows for the fund managers to get some sort of economics. And in today's climate, what's very common is that those fund managers will take basically a 90-10 split at the SPV level. Okay? Now, again, I'm going to say this probably once or twice more, but like all of this is a nuanced legal discussion that you should have with your attorney, not me, but like I'm just telling you it's a fact that this is happening. Some people are probably doing it correctly, some people are probably doing it incorrectly, but this is the structure that people are using. Okay, so here's a quick example. So I'll restate it real quick because I know I talk quickly. At the SPV level, there's a 90-10 split that's happening. So you're like, well, they're getting watered down. But they're not, because that entity is getting the preferential treatment. So net of the 90-10, those investors are actually getting the same or the exact same economics as if they had gone direct. Does that make sense? If it doesn't, we're going to break it down in just a second. So here's an example, in a deal we did recently, where we have a Class A investor that after they get the 7 pref and the 70-30 split, the net LP returns are 15.5% IRR. Then we have another class of shares for investors that are investing $500,000 or more, and they have an 8 pref with an 80-20 split. And then, so that LLC, that entity gets a 17.5% IRR, but the net of the 90-10 split, the returns are exactly the same. Does that make sense? Yes? Generally speaking, because they're making up for the fact that they got the better economics to the entity. Now again, a couple more times, but like talk to your attorneys, but right now, there's a typical structure that people are using where there's like a setup fee, an entity management fee, and then some sort of waterfall at the SPV level. And usually, when you put this all together, the current market dynamics are that if you were to do this in some iteration, if you raise $1 million, most people want to make something around 10% of what they raised if the deal goes to pro forma, when you add up all this stuff together. And when you take that, let's say $100K out, the net LP investors, the net return is going to be the same as if they had gone direct. But this way, the fund manager gets to manage his own entity. He gets to, or she gets to, receive all their investors directly to their entity versus going to the sponsor and potentially the sponsor marketing to those people again. So they control the entire experience at their SPV level. Now, I'm in the business of helping people raise capital, and obviously we want to raise money because we want to help investors, but we also want to make money. So but keep in mind, whenever I say something like this is not an income claim, right? Like, I'm going to tell you why people are doing this, but deals never go to pro forma. They go above and beyond and below and all that. So anyway, that's the structure of what the fund of funds model is, and it's freaking powerful. Like, it is incredibly powerful because it allows you to inspire your LPs to become entrepreneurs and see it as a business opportunity. So if you have a high-income dentist that is invested in 6 of your deals, they probably know 10 high-income dentists that they can pull together and do this exact thing. And once you unlock that in their minds, they will probably go and do it if you make it easy for them to do. So that's what we're going to talk about next, all right? So this is how we do this at ASIM Capital, and you can just copy it. I'm going to put a ton up on the screen. I'll tell you when to take a picture, and then I'll put up a ton more, and you can take a picture. So our whole way to make this work is not just say, hey, we have this structure. We try to make it as easy for them as possible. So we book a call to tell the story of the deal. We then send a 13-minute webinar about the deal itself to get them confidence in learning about the deal. We then give them all the editable marketing materials like the the PowerPoint deck, the email documents that they can copy and edit. Then, before we do anything with them sending out anything, we check any edits that they made because sometimes they make mistakes. We then record a webinar with them where we highlight them as a partner in the deal, which they are. We're not trying to say, oh, we own and control. We're like, oh, we're so amazing. It's an ego thing. No, we want to highlight them in their investors' eyes, and then we prompt them to book calls with their people. Not rely on the webinar, but prompt them to book calls. We will even go so far as to offer to do calls with their investors where we're highlighting them as the fund manager that we're so excited to work with because we're trying to make it as easy for them as possible. We're not trying to take their investors. We don't want to sour a relationship with someone that might invest $500,000 with us to take some 25 or 50K investor. So if you want to take a picture, this is part 1 of what we do. And you can just go and do this in your business. It's easy because if you already have the PowerPoint deck, you can just give it to someone and say, put your logo on it next to ours and make your edits and you'll be good to go. The next thing we'll do is we will offer to meet them on site at the property. We'll provide frequent check-ins during the raise. Sometimes we'll give them freaking therapy because it's hard to raise money right now. So if they thought they were going to raise $1 million and they're a little short, we're going to tell them, keep going, keep trying. Other people are coming up short. This is the nature of the game. People need to hear this stuff. Don't bail. This is the whole theme of 2025, right? It's supposed to be survive until 2025, and now we're seeing what's actually happening. It's just don't freaking bail. And by the way, if you haven't been in this industry for longer than 3 years, I'm just going to say this from stage. This is about as bad as it gets. This is about as bad as it gets. But you know that when you buy, when it's as bad as it gets, you know what's going to happen in 5 years, right? Keep that in mind. And if you've been in this business for longer than 5 years, you know what I'm talking about. So just freaking keep going. So back to this. All right. So if they're short, this is something else that we do because we have a lot of groups doing this. If they start to fall short on their raise, we will open the conversation for them partnering with someone else. Now, we don't force them into a partnership. We just have introductions. Hey, perhaps you guys could partner on a fund of funds. Now, I don't like the idea of them doing effectively the same thing as bringing in 30 partners, because that's the same thing we get into earlier, but to partner with another person where they both bring in, let's say, $250,000, that makes a lot of sense to me. So once they get there, this is the best part, and I see some people in the audience I'm super excited to highlight. So once they get to their $500,000 minimum, only then do they make an investment in starting with the legal documents. And we also provide fund administration and all that stuff, and then we're just try to be as good at operators and communicating as possible. And you can take a picture now, and I'm just gonna keep moving because I have a quick presentation I got a ton to get to. All right. Now, what this does, though, what I just outlined, all that stuff, it makes it very, very hands-off and low risk for them. There's essentially, if they like the deal, there's no reason that they wouldn't try. There's just no reason. Here's why. There's no risk for them financially. If they like the deal, there's no hurdle for them to move forward by just taking a PowerPoint deck and sending it out to their friends. It almost completely removes the risk of coming out of pocket because they don't need to go to legal until they've already gotten their commitments. if they come up short, you can even help them partner and keep going and still be basically compensated indirectly, not through you, but through their fund of funds for the work that they've done. And this is something we're doing right now. And I have to give a shout out because a lot of this is possible because the market is starting to evolve. So there's service providers that all they focus on is this, fund management. Entity creation, fund management. And so we work with a group called TribeVest, and I think they're in the audience. TribeVest, are you here? Make some noise. Okay, cool. So if you want to build something like this, they have been great to us. They've been sponsors of our event. They're members of our group and mastermind and community and all these things. So go talk to TribeVest. And there's other groups out there that do similar things. We just work with TribeVest, so I'm not trying to be biased. That's the reality. There are other groups, but TribeVest has been kicking butt for us, so we're super stoked about that. Is this helpful so far? We're getting somewhere? We're rocking out? All right. So that's, to me, this is like an industry-defining tool because, as you know, people want to get in this industry, generally speaking. It's a very lucrative industry, but it's a very time-consuming industry. And we don't want everyone that has a W-2 to not have an exit path if they want to exit. And so this is an excellent way to start building an exit plan if you're in a high-income W-2. You already know a network of high-income people, but you don't have the time for operations. This is a great strategy to do it. Plus, it's hard to raise money right now, so activating a couple $500,000, $1 million, $2 million check writers can really change your ability to close deals in today's climate. To prove this, I want to give you a couple examples of how this can go. Here's one example, all right? Good friend of mine named Haley John. Oh, shoot, her picture didn't work. That's okay. So she is a very experienced operator that works in Houston, and deal flow in her market dropped dramatically. And so she saw an opportunity, though, from market conditions and was like, we don't want to just not do deals right now in Houston. We got to keep moving. And so we presented this opportunity in the North Edge apartments with her. She committed to raise $500,000 for her LLC. She ended up raising $750,000. And so if you do the math, right, that's like $75,000 of estimated revenue, which is amazing. So round of applause for Haley. She rocks. Yes? She's awesome. She crushed it. Okay. Then another profile. So we got experienced operators that are just looking for more deal flow. Here's another profile. The Thomas brothers here, and it looks like their pictures didn't work, it's all good. They are actually local to Phoenix, so they know the market, but they don't have a long track record. And so what they were able to do was they were able to show investors the deal local to their market. They were able to rely on our background, track record, reputation, these kinds of things. In their first deal, they didn't have to deal with, you've never done a deal before. They didn't have to deal with buying a deal that's so tiny, like a duplex or something. They could buy an interest in a very large, awesome deal. Because of that, on their very first raise, they were able to raise $350,000. And their first deal looks like the revenues should be somewhere in that range, right? This is no guarantee it's going to happen. I guarantee it will not be exactly $35,000, but that's the business plan, right? And they didn't deal with track record objections. They just didn't because they were able to rely on ours, and we're the ones making the decisions of the deal. One other person I wanted to highlight, because in this climate, crazy stuff happens, is a friend of mine, Eric Burns, where he has a background as a firefighter. He had a goal of raising $250,000. It was going to be his first real raise like this, and there was some time delays, and we ended up getting it going almost in December, which is not a good time to raise money. But he decided to go for it anyway, because why wouldn't he? We're giving him all the marketing materials, the PowerPoint, the email template, just send it out. Just see what happens. There's no risk if you like the deal. And he ended up coming up short. And I've dealt with this a lot because I work with a lot of people that have raised a lot of money and some people that have raised not a lot of money. But the difference is just don't quit. That is truly the theme of 2025. So he kept going. He freaking kept going. And because we had planned for this, we were able to help him partner with another capital raiser. And together they got to that $500,000 minimum, and he was able to raise $75,000, which is awesome. And the thing is, this is his first deal, so he's in the game. That's how it's going to start for him, and he can compound on that. So there's a couple things I want you to take away from this. Number one, the fund-to-fund structure is certainly powerful. The nuances of the legal elements should be something that you talk deeply about an attorney that you work with that focuses on the Investment Company Act or the Investment Advisors Rules. Those are the rules in terms of that. The other element, though, is that more important than the structure or anything, just don't bail. Don't bail. Whatever I can do to help you remember, don't bail. That's the theme. And by the way, I'm talking to myself on that too. I'm a normal entrepreneur. I'm competitive. I don't like it when deals go south. I don't like dealing with challenges. But it's freaking hard. That's what makes the market cycle. So regardless of the structure, just freaking keep going. This industry works. And then in 5 years, they're going to be talking about how it's not even fair because you bought deals in 2025. Cool? All right. So if you want to be a case study like this, by the way, you don't have to do it with us, but you can do it with anybody. But if you want to work with us, you can text SCALE to this number right here, and we'll give you our entire playbook, and we'll also make it super easy for you to raise money, because that's all we do is try to make it easy for you. No risk, no upfront cost, no thing. And then, excuse me, and then if you're a sponsor and you want to see exactly what we're doing, you want a PDF that breaks down the whole thing, you can copy it and use it for your business. Just text SCALE to that number there, and we'll give you a PDF that breaks it down. It's not on an autoresponder. I have to go home and respond back to each peer. That was probably dumb, but it is what it is. And that's the whole thing. So I'm super grateful for you guys. Hopefully that was helpful. And if you see me running around, I'm happy to help you out and take a picture or whatever help your business. You guys are awesome. Thanks a ton.